RSUs are a form of equity compensation known as restricted share units. They're complicated, and misunderstanding them can cost you thousands of dollars lost to taxes. I'm Sam Lightman, a certified financial planner and founder of Millen Wealth Advisors in Canada. I advise people that work at places like Google, Salesforce, Microsoft, and Shopify, as well as startup founders in the tech space. And after watching this full video, you will know more about RSUs than all of your colleagues and know how to make the best possible financial decisions. Big companies like Google, Salesforce, Microsoft, Shopify, and Amazon, among many others, will use RSUs as a form of compensation as an incentive for highly skilled employees. They are granting you shares of their company with the condition that you stay for a certain period of time or that you meet specific performance metrics. So how does it work? In your compensation package, you will have a base salary, a bonus, and RSUs. RSUs will have two different key dates, the grant date and the vesting date. The grant date is when you are granted phantom shares. For example, you just started working at Microsoft, and every 3 years you get $100,000 worth of RSUs granted. When you get the initial grant of $100,000, that is granted to you in the form of something called phantom shares, which tracks the value of the company's stock without ownership rights. Say you were granted $100,000 worth of RSUs vesting over 3 years, and the company's stock is $200 per share. That means the company has already allocated 500 shares to you, even though you don't own those shares yet. You will if you stay at the company for the 3-year vesting period. Now, here is one of the most misunderstood aspects of RSUs, even by seasoned tech employees. In this example, the vesting schedule is quarterly for 3 years. That means you will get 41.66 shares per quarter. If the share price jumps significantly, then so does the dollar value of the 41.66 shares being vested. If it falls significantly, so does the dollar value of your 41.66 shares that are given to you quarterly. It's important to know how RSUs are taxed. I'm going to go through an overview of it here. There are two types of taxes owed on RSUs, and they're owed at different points in time. The first is income tax. I'm going to assume that your province of residence is in Ontario. Your base salary is $220,000. You get a bonus, which is 20% of your base salary, or $44,000. Your marginal tax rate is 53%. The RSUs vested per year, assuming no fluctuation in share price, would equal $33,333, which is $100,000 over 3 years. That $33,333 worth of shares gets given to you quarterly. So you divide that number by 4, and the pre-tax vesting per quarter is about $8,333 every quarter. Now you're gonna owe income taxes on that. And the way you do that math is you do $8,333 worth of shares, or the actual dollar value of the shares being granted, times your marginal tax rate. If you're in Ontario and you're making this much money, your marginal tax rate is going to be 53%. That means $4,416 worth of the $8,333 that you got granted to you are going to go to tax. I know I'm throwing a lot of numbers at you, but if you want to simplify it, just basically say 50% of whatever I'm getting on a quarterly basis is going to go to tax. That means that the net shares that you will own, or the net dollar value of the shares that you will own once they vest, in this example, would be $3,916 worth of your company's shares. Now, it's important to note that you will not be responsible for remitting the taxes. The company will do that for you automatically. They sell your shares immediately after they vest in your brokerage account and take care of the tax implications by remitting them to CRA. It's important to know that RSUs are taxable on the date the shares are vested, not granted. Remember, there's those two different dates: the grant date, which is when you are allocated the phantom shares, and the vest date, which is when they actually hit your brokerage account. There are certain rare instances where some of these compensation plans will qualify as a salary deferral arrangement, meaning that they'll actually be taxable when the RSUs are granted initially. This can cause a big tax headache, but most tech companies' compensation plans do not trigger SDAs, or salary deferral arrangements, as they all have big presences in Canada, so they already play by the Canadian government's tax rules. Now, there's a second taxable event. This event occurs when you decide to sell the shares that have been vested. This is called the capital gains tax. Let's say you get 100 shares vested at $150 per share. Then a year later, the shares are worth $160 per share. and you decide to sell those 100 shares. The vested price of the shares when you got them were $150. The current value is $160. You have 100 shares. That's net after that first income tax has been taken away. The value of shares at the vest date will be about $15,000. The value of the shares now, however, are $16,000. That means you have a $1,000 capital gain. Capital gains are taxed at a 50% inclusion rate, meaning only $500 of the $1,000 is actually taxable to you. And again, if you're at a marginal tax rate of 53%, then you'll owe $265 on that transaction. So your net proceeds after the double tax will be $15,735. Now, it's important to know that you can avoid a large capital gains tax hit by selling at the first available liquidity date and contributing the proceeds to an RRSP or tax-free savings account. If you contribute to an RRSP, you'll create a deduction against your income equal to the dollar value being contributed. This means you will get a large portion of the first tax you paid, the income tax on the vesting, back on your tax return the next calendar year. Your future growth is tax deferred, so if you want to buy back into your company shares, you can do that without immediate tax consequences. If you contribute the proceeds to a TFSA, however, there is no tax deduction against your income, but there is no tax on future growth of the shares if you decide to buy them back later. The last part here is where so many people lose money. It's important to consider diversifying your equity compensation. The reason being, in order to manage risk, it's crucial to not have your human capital, which is your earnings, and your investment capital all tied up in the same single company. That substantially increases your risk in the event of a sector-specific correction or recession. You could wind up in a situation where, like oil in 2014, your sector lays off employees and the market takes a big hit as well, effectively wiping out your earnings and investments all at the same time. A few key takeaways. RSUs are a form of stock compensation that vests over a specified period of time. RSUs are typically taxed when the shares are vested, usually at 50%. The company will take care of the tax liability by selling the shares when they hit your brokerage account and remitting them to CRA for you. Next, ensure that you are properly diversified once the shares vest in order to lower your risk. And lastly, consider selling shares and maximizing your registered plan contributions to lower the first and second taxable events. At Millen Wealth, we work with people in the tech sector just like you to build wealth strategies and manage risk and help you take control of your financial life. Reach out at the link below and subscribe if you want to see more tech-related finance content on YouTube.